As a trader, you've probably heard the old adage that it's best to trade with the trend. The trend, say all the pundits, is your friend. This is sage advice as long as you know and can accept that the trend can end. And then the trend is not your friend. Good afternoon, everybody. My name is Sean van den Berg, and I'm an investment specialist here at PSG Wealth. In this webinar today, we'll be discussing one of the important cornerstones of technical analysis, and that is analyzing market trends. So we'll be discussing three main ideas, namely what are an uptrend, downtrend, and sideways trend, what are bulls and bears, corrections and rallies, and daily fluctuations, and then thirdly, what are support and resistance trend lines. So my objective today is to show you how a basic building block forms the foundation of technical analysis and trading. Before we discuss a method of determining the trend and a simple method of anticipating the end of the trend, let's first look at the basic philosophy and assumptions of technical analysis. I see quite a few more people coming on board. Okay. Awesome. Okay, as I mentioned just now, this webinar is being recorded. Any questions you have, please type in the question box and we'll be able to handle it. Okay, awesome. Guys, yeah, guys are still coming in madly. Cool. Okay, so let's just say discuss the basic philosophy and assumptions of technical analysis. So first of all, the market value of a share is determined solely by the interaction of supply and demand. Now, the supply and demand is governed by numerous factors, both irrational, which is another way of looking at something being normal or reasonable, and irrational factors. In other words, anything that's illogical and foolish. So these factors include everything that's relied on by the fundamental analyst, obviously everything we know about a company, the fundamental, the numbers, etc., as well as all the opinions, moods, and guesses of all market players. And what the market does, the market's function is automatically weighs up all these factors on a continuous basis. So disregarding any minor fluctuations in the market, share prices tend to move in trends that persist for appreciable length of time. Now, changes in trends are caused by the shifts in supply and demand relationships. Now, these relationships, or these shifts rather, whatever the reason for their occurrence, can be detected in the market action of the market itself. And history tends to repeat itself. Every time I see that quote or that line, history repeats itself, I always remember what happened with me at school. History repeats itself. I used to fail history all the time. Okay, that's an old joke. So anyway, history tends to repeat itself, and this results in recurring cycles or trends. Okay, so that is just some quick overview. So let's build on this by discussing it a bit deeper. If you look at the expectations of all the market players, we talk about the market players. Market prices are determined by the expectations of those market players already in the market, as well as those contemplating getting in. The price of the price of a specific share at any one time is determined by the knowledge, hopes, fears, and expectations of all those people who already own it or might be thinking of own it. For example, if you're sitting on cash, you're affecting the price just as much as anyone who has bought a share. For by holding back from making the purchase, you're actually keeping the price lower than it otherwise would be. Did you ever think of that scenario? Okay, in other words, it's the underlying forces of supply and demand that causes a share price or market to move up or down. So when we have a rising market, more buyers than sellers pushing the price up, that's demand. In a falling market, we want more sellers than buyers, and we call that oversupply or supply, pushing the price down. So that's the first thing I want to highlight for you guys. What moves the market up and down? Supply and demand. Secondly, what's very important is prices are determined by changes in mass psychology. So markets reflect human action, and people tend to make the same mistakes over and over. Going back to what I said just now, history repeats itself. Human nature is more or less constant. But thank goodness, or fortunately, that these constant emotional swings keep reappearing in the markets or in the charts. So in the rising market, when we have demand, you can also think of the emotional context there as in greed. In the falling market, where there's more sellers than buyers, you can think of emotional emotion, fear. Okay, so those are the second thing I want to highlight. First of all, as I say, supply and demand, what moves the market. Secondly, is the mass psychology, and then thirdly, it's also important to understand that market participants look ahead. That's one of the most important concepts you can understand about the market. And when I say looking ahead, we anticipate future events, and this concept is called discounting. So the investors take, when the market takes a view ahead, and they take action now. So if you're standing, let me just use an analogy. If you're standing on a railway track and you see a train coming, is it likely that you will wait until the last moment before getting off the train tracks? No, you'd be crazy. So you'd anticipate that the train is going to run you over and you'll get off the tracks right away. So the market works exactly the same way. The difference is that not all market participants get all the news at the same time. Okay. So the sum of the attitude of all market players or potential market players is reflected in one thing and one thing only, the share price. This discounting mechanism I mentioned now is the reason that the markets bottom when the news is bad and peak when the news is good. At such points of extreme emotional activity, participants have already factored in today's headlines into the price and begin to anticipate tomorrow's headlines. Okay, so this morning we're anticipating NASPAS, the impact of NASPAS because of Tencent, and we see already that NASPAS was down 6% today because Tencent missed expectations. But that's the thing called discounting. Okay, so let's move on to our first very important concept, and that's discussing what is a trend. A trend is the general direction of the market or the price of a share. Most traders trade in the same direction as the trend, while contrarians seek to identify reversals. And we mentioned this before in past webinars. A contrarian is someone that buys when everyone else is selling and would sell when everyone else is buying. Okay, so let's talk about trend analysis in a bit more detail. It's important to, so let me just grab some water here quickly. Okay, it's important to understand trend analysis is arguably the most important area of technical analysis, as it's the key to determining the overall direction of a share or market. Okay, so when the share market moves in any one direction, generally up or down, it is easier to make trading decisions and ride it up or down. When the share is moving sideways or non-directionally, what I call trendless, trading decisions making is more difficult. Okay. However, there are opportunities to cash in on the uncertainty as well as continue to profit from the market. Understanding what trends look like and trading and the trading mentality behind it that will help you make more profitable trades. So trends are based on the simple principle of in an uptrend, higher highs. Let me bring in my little cursor here. Okay, we got higher highs and higher lows in an uptrend. In a downtrend, we have lower highs. That high is lower than that one, and that high is lower than that one. So we have lower highs and we have lower lows in a downtrend. Okay, let me just take this out again. Okay, so higher highs, higher lows, in a downtrend, lower highs, lower lows. In a sideways or horizontal trend or trendless market, okay, the price has regularly rebounded sideways from low and high levels. We're moving sideways. Okay, when the market is not showing any trend, it's either sideways or it's volatile with huge swings up or down in a short period of time. Trading becomes much more difficult and disproportionately less predictable. A sideways trend is a horizontal price movement that occurs when the forces of supply and demand are equal. In other words, the buyers and sellers are having a bit of a tug of war. This typically occurs during a period of consolidation. We've had a good up move and then the market takes a pause, okay, before deciding either to carry on this trend or continue on its trend, or break out and move down lower. Yeah. Sideways trend is also commonly known as a horizontal trend. It's interesting to note, a third of the time the market is moving sideways. Okay. We call it either when the market's either trending up or down, we call that a trending market. When the market moves sideways, we call that a trendless horizontal market, a trading market. Let's move on to determining support and resistance levels. So in a rising market, okay, a peak or reaction high is called a resistance. So I want you to understand the psychology behind it. You got more sellers than buyers, more buyers than sellers pushing the price up. We hit a ceiling, and more sellers coming to the market. So I'm going to highlight a resistance for you. A ceiling is a letter R standing for resistance. So we need to break out. So the market pulls back. So there's enough selling to push the price down slightly to overcome the buyers, and then the buyers will move up to the previous high or previous resistance level, and then break out above that. Okay, so the minute we break out above that, we have a continuation of the upward move. And so the market goes on. So higher highs, higher lows, the market pulls back. What's interesting to note, again, let me bring my little cursor in here. You can anticipate how far will the market pull back. It's usually around about the previous high, because that'll highlight for you what I call a turning point. So those are very important turning points in the market. So as it goes up, higher and higher, we have breakouts above previous highs. Okay, a breakout above previous highs or previous resistance levels. That's in the rising market. So those resistance levels, those ceilings are important turning points. It also helps you from a trading point of view as an entry point. So these little trend lines I've drawn here, these are what we call trend lines. These are horizontal trend lines, or I call them horizontal resistance levels. Okay, but it's important to you, and also as what I like to do, I like to use resistance trend lines. I like to make them blue to highlight resistance, and you'll see in a falling market, previous lows will be called support. So a breakout of a previous low, that there, if I bring in my cursor again, will be a trigger that the trend is definitely continuing downwards. How far will the market rally? Okay, we're talking the next slide about rallies. Market will rally to the previous support level. Okay. Get rid of my little cursor again. Okay, so in the falling market, we have a floor. Those floors are what we call support levels. So a break below support level will confirm that the trend will continue some falling. Okay, so an uptrend, a downtrend, and obviously a sideways trend. It's very important to draw those horizontal resistance and support trend levels in, because that will dictate either the market breaking up or breaking down. The point I'm trying to make is that you act on the breakout of those support and resistance levels. Okay, so remember, these are just pauses within a sideways in a trend, but we need to break out above it to confirm a continuation of the trend, either up or down. So let's talk about the bulls, the bears, corrections and rallies, and daily fluctuations. So what do I mean by all this? So we mentioned just now that as a technical analyst, you make use of various tools to do your analysis. So we discussed already that share prices move in a series of peaks and troughs, okay, highs and lows. The direction of these peaks and troughs will determine the direction of the trend of the market. The trend is a time measurement of the direction the price in the price levels, covering different time spans. Now, there are many different time spans or different trends, but the three trends that are most widely followed are the primary, secondary, or intermediate trends, and the minor and short-term trends. So a primary trend is the largest trend lasting more than a year, and I'll go into more detail with that. A secondary trend is the intermediate trend that lasts 3 weeks or to 3 months, and is often associated with a movement against the primary trend. Finally, the minor trend often lasts less than 3 weeks and is associated with the movements in the intermediate trend. So let me show you on a chart. I think it might be easier for you guys to understand that. So remember we mentioned just now higher lows, higher highs, higher lows. Long term is what we call the bull market. In the falling market, lower highs, lower lows is what we call a bear market. Remember, this is long term. This is a primary trend. Within the now, the primary trend is a major trend of the market and it moves. Obviously, this is the most important one to understand. Even if you're a short-term trader, your goal is to identify the primary trend. This is because the overriding trend is the one that affects the movements in the share price. The primary trend will also impact the secondary and minor trends. Now, we're talking about secondary trends in a bull market, rising market. Those little pullbacks, I call them pullbacks. We'll go into more detail. What's the definition of a correction just now? Here's my cursor. Cursor's disappeared. There we go. Okay, so this is what we call corrections. Those are corrections, and within a bear market, uh, these are called rallies. Those are little moves there against the prevailing long-term trend. Okay, so a primary trend consists of a bull trend or bull market, which is higher highs and higher lows. Okay, it takes longer to build a bull market, and a bear trend or bear market is lower highs and lower lows. It's when we have a bear trend that's usually shorter and sharper. Okay, so remember, as I mentioned, secondary trends consist of within a bull trend. These are called corrections or called corrections. And I always think of them as areas of profit taking. In a rally, I always think of the guys that got in the first time, didn't get out the right time. Now they're trying to break even. Okay, so that's the thinking behind it, the psychology. Let's take it a bit further and just look at a quick table. The primary trend, the secondary trend. If you look at time span, so a primary trend or your bull trend lasts between 1 and 2 years, and this is all based on, remember, the primary trend reflects the investor's attitude towards the unfolding fundamentals in the business cycle. Now, historically or statistically, a business cycle from trough to trough is approximately 3.6 years. So it follows that the rising and falling trend cycles, these are called bull and bear cycles, last between 1 and 2 years. Since I mentioned just now, since building up takes longer than pulling down, bull markets generally last longer than bear markets. Yeah. The secondary or intermediate trend, they last anywhere from 3 weeks to as long as 6 months or more. Remember, these are the counter-cyclical trends within the confines of a primary bull or bear market or bear trend. And then we have what they call the minor or short term. These last for anything from 1 to 4 weeks. So these are usually influenced by the random news events and are far more difficult to identify. And I think that's what's important. Let's look at the three trends in the chart. I think they'll illustrate for you better. So here we can see the long-term secular bull market. This is the JC All Share going all the way back. My data goes all the way back to 1985. Okay, so you can see that over the long term, we have higher highs, higher lows. Okay, so this is a long-term secular bull market. I'll grab some water again. Okay, so remember a primary bull market, by the way, is defined as advance of more than 20% from its primary bear market. Now, if you look at, over the years, there have been some healthy corrections. There's a little correction there, and there's a correction there, another one there, and more recently, in 1998. Let me just bring in my little cursor here. So way back in 1987, we had a healthy correction. It was 87 crash. It was mainly blamed on computers, the advent of computers and stop losses and things like that. But there the market fell 45.3%. It took the market nearly 2 years to break up above its previous high to resume a bull market. Remember, it has to move up more than 20% above its previous high to confirm a bull market. So that was way back in 87. Back in 98 was what they called the Asian contagion. This is when the Thai baht devalued. Our interest rates went up from, I think it was 17% to 24%, very short period of time. Interest rates went up, market came down. You can see there, 44%. In 2000, that was blamed the NASDAQ.com or the NASDAQ bubble. All the websites that weren't valued anything, and there you can see a 36% drop. And more recently, way back in 2008, that's what we call the subprime story. where the properties were overvalued, or some properties were sold to people with no jobs and they couldn't pay for it, and there was this whole bubble bursting in the property sector. Again, roughly about a 44% collapse. Again, took the market more than 3 years to break above the previous high set at the beginning of 2008. Okay, so what's interesting to note is the length of time between all these strings. Between 87 and 98, we had 10 years. That was how long the bull market was there. And then the next bull market lasted 4 years. And then after that was 5 years. What is interesting to note right now, our current bull market is more than 10 years old. Okay, that's quite interesting to look at it that way. Just understand that a 20% drop signals a start of a primary bear market. So as I say, it takes the market about 2 years to recover. So that's your bear market, 2 years, while we recover above the previous high. Again, it took the market nearly 2 years there, and again 2 years there. Okay, so that's how long a bear market lasts. Bull market is a bit longer, bear markets are sharper and shorter. Okay, so let's look at secondary trends. Go into more detail here. And secondary trend is obviously, just to recap quickly, a primary trend is the main direction in which the market is moving. So a secondary or intermediate trend moves in the opposite direction of the primary trend, or is a correction of the primary trend. So in general, the secondary or secondary intermediate trend typically lasts, again, from 3 weeks to 3 months. Okay. So yeah, I'm looking at a Sibanye gold shares, and I'm using this example just to highlight, and this is an extreme example of the corrections in the market. So you can see Sibanye, every time it pulls back, you can see some of these pullbacks are more than your 20%. So these will classically be called very healthy corrections or crashes. But you can see just that scenario here. Let me highlight some of these things for you. This, again, remember, it's a gold share. It is volatile. From there to there, that was a 58% drop. From there to there, that was a 31% drop. From there to there, 27% drop. We needed to break out above our previous highs to confirm a bull market. Okay. And then we have that little correction from that high to that low there as a 35%. We need to break above it. It did. It was a bit of a false breakout and then pulled away back again. That little breakout, that correction there, very healthy, 57%. And then we had a nice little rally, okay, all the way to the top and then the pull back again. That was a 28% drop. From there to there, 68% drop. Okay, these are what they call rallies within a bear market. Okay, so you can see that high is much lower than that one. That one's lower than that one. So this is what they call a bear market. But these are rallies within the bear market. So I'm just highlighting Sibanye as an example of extreme corrections. Okay, so bottom line, Sibanye or any gold shares is not for widows and orphans because of these pullbacks. Okay, and then obviously we go to our shorter term trend. And yeah, we're looking at what we call the minor trend. So minor trend, and in this example, I'm using candlesticks, and a minor trend, which is defined as a market movement lasting less than 3 weeks. Okay, so I call it minor trend, or you can also look at it as the minor the daily fluctuations. These are corrective moves within a secondary move, so within a rally or a correction goes against the secondary trend. So most, obviously, long-term investors will ignore these daily fluctuations, but obviously you'll take it in context that these will have, because of the noise, you'll ignore it. You'll be looking at more the secondary and your primary cycles as a long-term investor. Even as a position trader, you'll look at maybe the minor trend and candlestick charts, and in future webinars, I think in November, I'll be discussing candlestick charts again, or patterns. As a position trader, you use that as an entry level. But as a normal investor, remember, your focus is still on the primary trend. Okay. The problem of focusing on the minor trend, it leads to irrational trading. And this is where we get very emotional. And obviously, traders get distracted by the short-term volatility and lose sight of the bigger picture. Stated simply, the greater the time period a trend comprises, the more important the trend. Okay, so I hope those very simplistic way of looking at the 3 trends will help you. So let's look at a very important tool. And here we talk about support and resistance trend lines. So we've spoken about market psychology and obviously the underlying factors that can move the market. But, market prices I mentioned just now are determined by the expectations of those already in the market, as well as the market psychology. Those are, and obviously discounting. Those are three very important concepts to understand. So I want to introduce a very important but simple trading tool, and that's what I mentioned just now is support and resistance trend lines. So here again, we're looking at the JC All Share. If you had to go right now and type in the word stock market correction into Google search engine, you're going to be flooded with whole lot of articles preaching, obviously, impending deviation from the current bull market rally that has been obviously going on for more than 10 years, as I mentioned just now. Along with the words inflation and deflation and recession and correction, or a correction serves to invoke the sense of apprehension and dread within the markets, within the public's perception of a fragile and obviously manipulated market. By looking at this chart here, you can see I'm drawing from a prominent low to a second point. Let me get my cursor here again. Okay. So from a prominent low to a second point, and I extrapolate it. The more time, there I touch the third time. And in my next slide, we'll go into more detail. But this is what they call a support trend line. I'm supporting the prices as long as the price stays above this long-term support trend line, the trend is up. Okay, yeah, I've drawn from a prominent high to second point, so third point. The more times it touches, a very reliable resistance trend line. There I can see a change in trend. Okay, I can also use that previous high. That high is higher than that one, and that's a confirmation of the change in trend. Yes, I need to go way above that to confirm a bull market. That is still a sideways market. Only up top here did we break out of it. Didn't last very long and it pulled back again. And then extrapolated long term, that's when the market went up again. Okay. So by connecting the highs, and this is the current chart, this was 2 days ago, I can see we had a very important turning point. This is a resistance trend line. Touched once, come very close there. 2, 3 times, 4 times, and this is an important trend line. Are we going to break out, or are we going to touch and come back again and to retest as a previous low? Okay, going forward in upcoming webinars, we'll be talking about chart patterns and things like that. This could be forming what they call a triangle, important continuation pattern. But what's important to understand from this is what's the implications of trend lines? And this is a very important tool to use. So let's build on those implications. Okay. So first of all, you need to look at the length of the trend line. The more times it touches, the more reliable it touches. The longer it takes, the more reliable that trend line is. Okay. So it's important that it must touch at least 3 times. You saw my example now, it's touched quite a few times. So that's quite important support and resistance levels or trend lines. Secondly, we look at minor penetrations. I mentioned just now we have these little false breakouts, the market pulls back again. So minor penetration compromises the trend lines, and you'd see obviously other tools, and we'll talk about it in future webinars, like moving averages to help you to just make a informed decision. Otherwise, you're going to lose a lot of your trading capital or your investment capital. So minor penetrations can be false signals. Then we also have valid penetrations of that trend line. A valid penetration happens when the share closes above or below a support and resistance trend line. And a rule of thumb is about 3%. Anything, if it moves and closes more than 3% above your support, above your resistance trend line, or 3% below your support trend line, that's a valid penetration. When I say penetration, I say it's a trigger, it's a change in trend. And then what's important is you can use trend lines in that as for price objectives. And when I say price objectives, and prices usually move a distance beyond a trend line. And that's equal to the vertical distance that prices have achieved on the other side of the trend line. So example, if the price uptrend, it was 5 Rand, you can measure it from 5 Rand above that. So you can use it as a price objective, vice versa. And very important, I think this is the most important thing apart from point number 1, is the angle of the ascent or descent of the trend line. So many people use a 45-degree trend line as a very important tool. So the idea there is the slope of the angle is important because the rate, 45-degree angle, the rate of the price and the time is in perfect balance. So a lot of guys will draw from the, and going back to my previous slide, you'll see that was roughly about a 45-degree angle, either up or down. Okay, very important way to look at trend lines. Okay, so guys, just summing up quickly. As a trading strategy, going back to my Sabania Gold, you'd enter a long position where the share is trending higher. So yeah, we had a double bottom. We can talk about chart patterns later. That's a double bottom, and that high is still lower than that one. But we started to make higher lows. We broke up above a previous high. You can see that's a bit of a breakout there. Came back to retest. That resistance trend line acts like a support trend line, and that's where you'd enter a trade. Okay, you can be a bit more conservative. Wait until we break up above that, and only regarding over there. But you can see the trend line will keep you in the trend until such time. Okay, by the way, you replace your stop loss just below that and your stop loss just below that as the entry level. Your exit for the profit is when it starts reversing. So you would have said, okay, that high, that low there would have been lower than that one. You could have got out over there, or the breakout of a trend line. It's a simple trading strategy using just trend lines. Okay, we'll build it. There's much more. There's more other indicators you can use, moving averages. You can use other momentum indicators. But in this context today, we're talking about trend lines. Okay, so guys, I'm going to summarize them quickly. I see we run out of time. Okay. Remember, the theme of today's presentation was the trend is your friend until it bends. Okay, so looking at this long-term chart of the JSE All Share, first of all, you can see that the trend line has never been broken. Okay, so many prudent investors would say it's not timing the market, it is time in the market. Okay, so that just highlights for you the long-term secular bull market. So think of that. It's not timing the market, it's time in the market. However, saying that, some of you might be worried about the market right now. So the prudent traders, first of all, would be saying, okay, looking at the shares in my portfolio as an investor, I'll be looking at value shares. Value shares, remember, the main thinking behind that is margin of safety. If I buy the share right now, I know it's near the bottom, it can't go much lower. By the way, we'll be discussing this again in next month's webinar. We're talking value stocks, but more specifically growth stocks. But last month we spoke about it. You can go review the online YouTube video, talk about value investing. So that's one way of looking at it. That's one way of compensating what's happening on the market right now. Look at value stocks, number one. Number two, you might want to use a stop loss strategy. So you might say, okay, my overvalued stocks, I'm going to put a 20% trailing stop loss in. So if it does drop 20%, I'm out. Okay, another way of managing your investment portfolio right now. Thirdly, and this is very prudent, is to have a diversified investment portfolio. When I say diversified investment portfolio, because of geopolitical risk and things like that, you might want to open up an offshore account. That's one way of looking at it. Or you have a local share trading account, but have exposure offshore through ETFs. There's a whole range of ETFs. You can have exposure to the US markets, Europe, Japan, whatever you want to. Okay, even to China as well as into Africa, if you want to look at it that way. But diversify along the lines of geopolitical risk or geo-diversification, because I don't want to only be exposed to JSE, I want to be exposed to world markets. And then the fourth step that you can do is obviously a hedging strategy. As a long-term investor, you might want to use single stock futures or CFD as a way to hedge. So you want to sell your shares to trigger capital gains. You want to maybe use a hedging strategy. What you lose on the swings, you make up on the roundabouts, and that's how you'd go about creating a managed portfolio that way. Okay. So guys, just to summarize, bottom line, trend lines are incredible, useful tools in determining the direction of the share and developing a bullish or bearish stance. So just looking at this chart now, this long-term support trend line, that's what I'm trying to reinforce for you guys. Trend analysis includes the use of trend breaks, which I've spoken before, which may signal corrections or complete trend reversals. Trends can be drawn across multiple time frames. Remember, bulls and bears, corrections and rallies. And the smaller trends may help a trader avoid the corrections that occur in the larger time frames. By combining other technical analysis tools, and as I say, we'll be discussing it in In October, we're discussing moving averages and other technical indicators, and then fine-tuning the analysis with observation of candles patterns. For example, a trader can stack the odds of making a successful trade in his or her favor. So finally, people, just as I wrap this up, remember trading is a craft, which means that it's both an art and a science, and requires practice to develop consistency and profitability. Okay, so we spoke about uptrends, downtrends, and sideways trends, bulls and bears, corrections and rallies, and support and resistance trend lines. I suggest go online, go look at our online tutorial. Tutorial number 8 goes into these basics. Okay, so again, reinforcing it. The webinar recording will be emailed to you guys soon. If I can ask you, please share that on social media. So from my side, good luck and happy trading. Let's look at some of the questions you guys might have. No questions. Wow. Nothing. You guys still with me? Hello? No questions. Hello? Hello, hello, hello? Guys, looks like if there's no questions, wow, so I'm surprised. Sure, stay there, stay here, no questions. Still here, okay. Thanks, Alexander, thanks, appreciate it. Okay. Guys, looks like there's no questions. All good, all good. So my objective today was to introduce a basic tool. And I think a lot of us don't use it properly, but hopefully it's planted some seeds for you guys. Go through the recording to reinforce lots of ideas for you, and just go apply it in charts and see how it takes it from there. So guys, from my side, thank you very much for your time today. Here's my disclaimer. Remember, everything I say today is mainly for education purposes. I'm not giving any tips. I didn't give any tips anyway, or advice, but remember, it's for education purposes only. If you guys want to contact me, there's my email address, and there's our toll-free number for you guys if you want to get a hold of me. So from my side, thank you very much for being on this webinar. Until next month, all the best. Bye for now.